I will go. Right. Hi, good afternoon, everyone. My name is Richard Perry, and I am the market analyst at Hantech Markets. This is my second webinar of my series of tips to save you pips webinars that I'm going to host for you for FX Street. And I hope that you just can pick up a few benefits of the knowledge that I've gleaned from the over the years, and hopefully that can help you through your trading. Now, before we start, as per usual, let me just do this fancy new bit of software we've got going on here. Anyway, disclaimer, always got to show you the disclaimer because I'm going to be talking about live market information in a bit. First of all, I'm going to start off with a bit of theory and then do some live market stuff. So you need to read and understand that disclaimer purely for the legal reasons. And a little bit about me, as per usual, not much changes. Worked in the city for 14 years now and doing FX analysis, equity analysis. And I do across a range of analysis techniques using technicals and fundamentals. And hopefully that suggests to you that I, to a certain extent, know what I'm talking about. Right, the agenda today. What I'm going to talk about is, as I said, the benefits of trade management, which is what the webinar is called, and we're going to look at just sort of highlight a few issues that traders get when they're trading, and a few things that you can hopefully do to try and avoid some of the mistakes that a lot of traders do make. And I'm going to look at how emotion trading can have a big impact on your trading. What the emotions are and how you can identify them and what you can do to combat them. And then I'm going to focus on the use of stop losses. There's a big debate around stop losses, and I fairly firmly come down on the side of using stop losses. And I think that you can engage stop losses to help your trading as well. And also a little bit of trade management as well. So we're going to talk all about that. Hopefully it won't take too long, maybe 25 minutes or so, half an hour, and then I'll have a big run at a fair bit of live market analysis for you, looking at some big moves on these markets in recent days, and need to go through that. And if at any time you want me to look through something that you're looking at, then please just give me a shout on the chat box. It's all good, and I will do what I can to help you out. Right, okay, just to start off with then, now in my first webinar I did talk about the importance of having a trading strategy, and in that webinar I sort of briefly touched upon two factors that I think can have a big impact on your account, and that is first of all emotion trading, which I think is a big negative that can impact on your account, and then also on trade management, which is through the use of stop losses and other sort of ways of playing around with your account, which I think can be a big positive for your trading as well. Now, I think it's important to realize that pressing the button on a trade is actually the relatively easy bit. The tough part is actually making profit on your trading, and not only that, really making sort of a substantial profit, which actually means something to your account. So that's what I'm going to try and help you with today. I would actually argue that if you can successfully manage your positions, you may not even need to get your decision making right even more than half the time, because if you're actually very good at trade management, you can actually sort of manipulate your positions in a way that actually means that you can sort of make money, basically, even if you're right only half the time. There's a big quote in technical or which is run your winners and cut your losers, and that is a big aspect, I think, of trade management. It's difficult to put in practice, but I think partly because you need to get a handle of emotion trading and all the different emotions that can impact upon your trading through the time. Now I'm going to also focus, as I said, on trade management into your strategy and how that can also help your trading. And I'm going to sort of touch on a couple of technical indicators that I think you can use to help you decide whether to run your trades or whether to cut your trades. Right, so the first thing first reason I think for poor trade management is due to emotion trading. Now, emotions can certainly have a big impact on your strategy, and you need to understand that you're not going to profit from every single trade you put on. And in fact, if you're, as I said earlier, just if your trade management is good, then you don't need to actually be right the majority of the time. So you can get away with actually being as I said earlier, manipulating your trades to make sure that you don't actually need to just get everything right, really. But you need to understand that at the end of the day, you are going to make mistakes, and they're going to be the odd bad trade every now and again. We're only human, and the markets have a tendency to sometimes be fairly unpredictable, so that can have a big impact on your positions. And what you need to do is you need to learn from every trade you make. I would say keep a trading diary is my first key tip to you. Just have a think about it. First of all, why did you put your trade on at the time? Maybe think about the market conditions that were present when you did them, and potentially why it went wrong, or even why it went right. Actually, I think it's also important to sort of just sort of appreciate when you get things right as well as you get things wrong, and also mark down the time at which you put all your trading, because that can have an impact, I think. So, just if you do all these sort of little trading diary aspects of your trading and sort of analysing what you are doing, then you can perhaps even make a little bit of a tweak here and there to your trading strategy, and make sure that you don't make the same mistake again if you can avoid it. Right, so in terms of emotions, there are two different aspects to emotion trading, and that's emotions that are driven from winning trades and emotions that are driven from losing trades. Just very quickly on the winning trades, because there are not too many, but basically complacency and arrogance, I think, are the two that you need to be concerned about. Complacency is basically where you think you've just nailed it, and you basically just put trades on without really putting in the required thought process, and obviously that is a big problem, because that again goes against your trading strategy. And also arrogance as well, getting arrogant with your success, and that can lead to you taking positions in perhaps too great a size or excessive risk taking, and that can obviously lead to significant problems as well with your account. So winning trades doesn't necessarily mean you're sort of the best trader in the world, and you can generate mistakes off that as well. On the flip side of that, I suppose you've got your losing trades, and all the emotions that you get from doing engaging a losing trade, really. Sort of anger being the first one, or resentment, a feeling of revenge. Now, I know revenge trading is a big aspect of trading, because you sort of put a trade on, it's gone wrong, and you really are annoyed about that losing trade, and you then sort of start trading in a very rash manner, and without due consideration, which is a big problem. A similar sort of way, I suppose, you can feel resentful, and you can get a feeling that you need to get even with the market, and I would argue that if you're having a bad day, just let it go, really. Just leave it. Never let a bad day get worse, because that is, I mean, it can be a big problem, because you're not necessarily in the right mindset if you're having a really bad day to put trades on in a proper fashion. I'm going to look at next time I have my webinar. I'm going to look at the perils of overtrading, which I think is another big aspect. And can be a big costly mistake to you. But if you've ever made the mistake or if you've ever made a mistake, or you even make a series of mistakes in a row, just let it go. Just be careful not to trade out of anger, because it's going to have a big impact across your strategy. And at the end of the day, you are not a gambler, you're a trader. So you need to just keep that in mind. Pride is another aspect, negative emotions that you can feel. Perhaps pride would be sort of preventing you from closing a position in a loss. And as I said earlier, you're looking to cut the losers and run the winners. So if you're in a position of a losing trade, your pride can sort of take over and think, oh well, I don't want to lose this trade, and I don't want to have that sort of hanging over me, the loss. Well, you need to get out of that mindset. You need to accept that you will make losing trades, and you need to understand your limitations, because even the best traders will incur losses. And you need to accept that your losses will happen, and that is what comes with being a successful trader. Don't wallow in your mistakes. Learn from them. Depression and fear, I suppose, can also be a debilitating impact on your ability to press the button on a trade. I mean, for example, I've spoken to a load of traders over the years, and they've got a few trades wrong in the end, and they got a few trades wrong in a row, and they sort of lose all their confidence when they're trading. And if you do feel that happening to yourself, go back to square one. Go back to your strategy. Think about what you're doing. Remember why you're putting on your positions, and just basically go back to the beginning again, because it should help to give you some clarity in your thought process once more, and it'll hopefully sort of taking a step back can I think have a big impact on emotion trading, and just sort of being able to sort of let it bypass. If you do find that you're having these issues, maybe you do need to have a tweak to your strategy, but don't ditch it altogether. Remember why you put your strategy together. It may not be necessarily the completely the be-all and end-all of your trading, and you might need to make a tweak to it. But just remember, there's a big ground a basis to your trading strategy, and you've obviously thought about it thoroughly. So there's no need to ditch it entirely. Right. So basically, are you being compromised by your emotions? If you are, then I think you need to think about how you can overcome these to get back to your strategy. As I said, trade management looks to reduce or hopefully even remove the emotional side of trading by managing your positions. But ultimately, the things that you're looking to do is to be rational in your thinking. You want to be sticking to your trading plan. I'd say you also want to be consistent in your trading. Being a consistent trader is, I think, very important to your strategy, and basically you're just sticking to your predefined trading plan will help to drive this consistency. And ultimately, at the end of the day, you need to always remember to keep your eye on the prize and remember why you're doing what you're doing. And you've got a little key tip here at the bottom, which is if you do feel yourself getting overcome by emotion, take a step back, take a deep breath, and ask yourself, should I actually be doing this trade? And I think that is an important question you need to ask yourselves. Right, stop losses. Now, a stop loss, just a little bit of a definition, I suppose. A stop loss is an automatic order placed in the market that closes a position should the market move against you. Now, stop losses can prevent losses from spiraling out of your control, which I think is the main reason why certainly sort of beginners or novice traders should use them. The use of stop loss is a massively debatable topic, and I think you'll probably be able to find on the internet some trading guru that says, "Oh, you don't need stop losses, don't need to run stop losses. They're just not helpful to your account." Now, that's all well and good. These trading gurus are gurus. I mean, they basically have been trading for years and years and years, and maybe they've now got to a stage at which they can trade properly without the use of a stop loss. All well and good to them, happy days. But I would say when you're starting out on your trading and you're a bit of a novice trader, you're going to make mistakes and you're going to call the market wrong. And for that regard, you need protection. And I would say that that is a very, very important reason why you should have a stop loss in place. Now, in my opinion, stop losses, as I said, are an absolutely vital tool to your trading strategy. Especially if you're trading on a short-term basis, and as I said, especially if you do not consider yourself to be an expert in trading. Unless you've got incredibly deep pockets now, that would mean that trading without a stop loss can be a massive, massive negative for your account. And you need to just understand that if you put a trade on and you don't have a stop loss, when you thought you've got an adequate risk per trade in, that can turn into an enormous hole in your account. So just keep that in mind. Just as an example, I suppose, I mean, just a couple of months ago, or not even a couple of months ago, just the beginning of April, the ECB, for example, had just started QE, and Federal Reserve was seemingly on its way towards a tightening monetary policy. Everyone was bearish on the euro, everyone was bullish on the dollar. So subsequently, being short on euro dollar was the popular trade of the day. And also, I suppose, long dollar positions pretty much across most pairs were working incredibly well. Happy days. However, in mid-April, the euro rallied 700 pips in just under 3 weeks, and cable rallied 900 pips. Now, just think about it. If you'd been running a short position on either of these two, or heaven forbid, in both at the same time, depending on the size of trade you would have taken, these losses could well have been an absolutely crippling impact on your account. But if you'd put a stop loss in and you'd been able to make sure that you could manage your downside risk, then you would have been able to avoid massive losses. But I would say subsequently, stop losses are very, very important and a vital part of your trade management. Now, key question, why have a stop loss? Without a stop, I think it's very difficult to manage the downside risk on trading. As I said earlier, with the whole pride aspect of trading, human nature can kick in, and you might not want to cut a position due to the size of the loss that you're running. You might think, okay, well, I'll be able to trade my way out of it. Just run the loss, and it'll be. I'll keep my fingers crossed. Don't trade with your fingers crossed, because that is just not the way you should do it. You should be trading with conviction. Trading with hope is never going to get you anywhere. As I said, pride can be an incredibly bad thing to happen if you're trading in a loss situation. You can see the losses becoming larger and larger and larger, spiraling out of control. If you do nothing, then the downside risk could potentially be unlimited, I suppose, almost. But you could easily and quickly wipe your account out if you're trading in size and without an adequate stop loss. So if nothing else, having a stop loss would probably give you a better night's sleep, to be honest. And also, just as a technicality as well, if you can identify the size of the stop loss, it is also an important way of working out your risk per trade, and also generating the trade size that you're looking to put on. So very important that you start to think about your stop losses. So question is, how do you derive your stop losses? Now, there's a number of different ways to derive your stop losses. You can just look at your trading strategy, look at your risk per trade in your trading strategy, and that would generate obviously a number of the size of the stop loss, or the number of pips that you can afford to take on. So in terms of size, I mean, I suppose depending on the risk profile of your trading, perhaps a risk reward ratio of profit target to your stop loss could be somewhere maybe between, I don't know, maybe sort of 2 to 1 to 3 to 1. So you're looking at, say, for example, you've got 100, maybe 150 pips on a trade that you're looking out for your target, your target. Maybe you'd think about a stop loss somewhere in the region of maybe 50 pips. Again, it depends on your trading time horizon, but that's a sort of a basic way of looking at it. And again, it would depend on the conviction that you've got in your trading as to the size of the stop loss you might want to take on. Say, for example, if you're very confident that this trade is a good trade, and you're looking for 100 pips, maybe you'd have a smaller stop, and hence being able to generate a larger position. But just bear in mind that having a stop loss, I think, is very important. Other people use technical levels, supports and resistances. So you'd be using key supports for your long positions, or key resistance for your short positions. They can come in a variety of different ways. For example, with price levels or Fibonacci levels are very popular in technical analysis. But ideally, what I would say is a little bit of a tip here: give yourself a little bit of room around the key levels, because I would say that the banks pretty much know that retail traders will sit around the key support and resistance levels, and that's where they'll put their that's where retail traders will put their stop losses. So they basically are then able to sort of hoover up all these stop losses in one big order, and you wonder why the price has spiked very quickly through your stop, only to hit it by a few pips and then to rally back again. So there is a reason for that happening, and that is due to, or quite often due to, the big banks just knowing where all the stop losses are. So I would say give yourself a bit of room around the key stop losses. Give yourself 5, 10, 15 pips maybe underneath key support levels or over the top of key resistance levels, because I think that will help you to stay in trades for longer than maybe you would have done in the past. Another key tip: never extend your stop losses. Now, I think this is probably the most important one to do, because this is, again, if you start extending your stop losses, that is a suggestion that you're trading with emotion, because you are getting that's that old aspect of pride again. You don't want the stop loss to be hit, so you think, okay, well, if I'm close to it, I still think the trade's okay, so I'll extend the stop loss. There is a reason why you put that stop loss in place in the first place. Trust your analysis, because it's very important that you need to just accept the fact that occasionally you will get some trades wrong, and extending your stop losses, I think, is therefore it's a very bad move, and can, as I said, can be a very big red warning sign of emotion trading. Right, managing your positions. I think managing your positions is a very important thing that you can be doing as you are trading. I would say don't sit idle whilst you're trading, and you can potentially see a nice healthy profit turn into be a stopped out loss. And I would say an active trade management can help to prevent this. I would say that if the conditions of your trade have changed whilst the position is running, manage your position, because markets do not stay constant for long. There's always different aspects coming into the market and out of the market, different news flow, different fundamentals and things like that. So you need to be aware that markets do change, and managing your position is very important with that. So, as I said earlier, you want to be running your winners and cutting your losers. Now, so think about it. If you're going to be right around about half the time, and if the losses that you incur are greater than the winners because of your poor trade management, you can still end up losing money. So, say for example, you're putting in a stop every time of 50 pips, and you are not very good at your trade management, and you sort of start taking your profits when you're, say, 20 pips up. You can do that, and if you trade and you're right just half the time, then I would say that you're going to start losing money, aren't you? Because you're losing half the trades you're losing 50 pips, and the other half you're only winning 20 pips. So I would say you need to be managing your positions in a very intelligent manner. So into trade management. So what you need to be doing is just basically you need to think about adjusting your stop to take account of the gains whilst you're running your trade. So if you're, say for example, you're running on a 2-to-1 risk reward rate, 2-to-1 profit to loss ratio, with 50 pips of risk, you need to be looking for 100 pips of profit. But if your position moves into, say for example, 50 pips of profit, and you don't change your stop or your target, then the risk reward will get skewed the other way. So you're only then for sort of going for at that moment in time, you're sort of only in the market for 50 pips worth of profit ultimately, but you could potentially lose 100 pips on the downside. So your risk reward is completely skewed the other way. So if you don't manage that position, then you're going to be sort of impacting on your risk reward. So at that stage, you've got a few different options you can engage. You can basically, option number one, I suppose, you can adjust your stop to entry. So effectively, you've got a free run at the trade. So your risk reward ultimately becomes therefore 50 pips of profit to 50 pips of loss. So you got a free trade, but then at that stage, if you do that, you're only on one-to-one risk reward. So that's quite a risk-averse way of trading. However, you could tighten your stop loss even further to give you that guaranteed profit and maintain your risk reward. So if you've got 50 pips towards your target and you keep that target in place, maybe if you put your stop loss up to 25 pips below the current price, therefore you're still running your 2-to-1 risk reward ratio. Third option would be probably the most active and the most sort of bullish way of doing it, I suppose. And as I said earlier, looking to run your winners. So the third option would be to move both your stop loss and your price profit trigger, your target. So perhaps you're sitting in 50 pips worth of profit. Maybe you could then move your stop to flat, so you still keep a 50 pip of profit. But you could then also extend your target by 50 pips. So therefore, you would ultimately maintain that risk reward ratio. But key tip here, I've got at the bottom: look at the market conditions before you're making the decision. Basically, if you're getting corrective signals coming through into your trade, what you probably want to be doing is you might want to ramp up your stop all the way close to your position, so that if there is if there is a reversal in the trade, then you don't lose out on too much of the profit that you'd built up, because, as I said, markets do change. However, if the signals remain strong, then you might want to be a touch more risky and keep that stop a little bit wider, so you can ride out the trade, because the market signals remain strong. However, obviously, despite strong market signals, you get a bit of noise in the trade potentially. So keep that stop fairly wide, and then you can still be in sort of the market to run the trade, because ultimately you're looking to run the winners, and that, I think, is the most important thing you need to be looking at for. So as I said, markets are constantly changing, market conditions constantly moving. You've got data, information, and expectations constantly changing across markets. So I mean, for example, running the losers is a frequent mistake that beginners make. So if markets are changing and have gone against you, but you've not yet been stopped out, I would say to ultimately to think seriously about closing your position. Say you put say for example you put a trade on, and you've got you've gone long on a dollar position. So ultimately, say for example you've gone short euro dollar, so you're positive on the dollar, and you get a bit of dollar negative news comes out. Say, for example, I don't know, retail sales in the US misses expectations, and that would suggest that the dollar would weaken on the back of that. However, if you're still running a trade and you know that has happened and the expectations of the market has changed, and you're still sitting in your profit, why would you still hold on to that position? There's no point in holding on to that position, because you're just going to watch that position get taken out ultimately. You can save yourself, 10, 20 pips or whatever, by closing out that position. If the market conditions have changed, react with the change. That is what I would say. I would also ask, say for you to ask yourself, would you still put that new trade on if the market conditions have changed now? So if in the current climate, if the market conditions have changed, would you still hold that trade? If the answer is no, then I would say that you should be closing out your position. And therefore you would save yourself an extra loss to your account. You don't really need to just watch happen, because react in a changing market. But again, obviously the same is true of a winning position as well, because say, for example, you're in profit and then something happens to change the outlook of the market. Be ready to lock in the profit if needed. Again, just be able to react to market changing conditions. Right, so finally, just have a quick look at a couple of technical indicators you can use what sort of as profit taking or sort of market changing conditions, and there are two technical indicators that I like to use: are Bollinger Bands and parabolic SARs. Actually, now Bollinger Bands show the extent of volatility that are in a position, and you can take and I think you should take account of this when volatility, say for example, is at extreme levels. And once again, it would, as I said earlier, it would depend on your time horizon, and also parabolic SARs as well. I'll just show you in a sec. But parabolic SARs, a technical indicator that basically act like a trailing stop loss on your charts effectively. When parabolic SARs have been tripped, basically that's in a strong trending market. When the parabolic SARs have been tripped, that is a signal that the trend may be about to change, and you should probably think about taking your profits on that position. Now, let me just show you these two in practice. Now, these are Bollinger Bands. Anyone who was on my Bollinger Bands webinar will know all about how Bollinger Bands are looking. And this is a Bollinger Bands on the euro. So you've got this this move currently on the euro, Bollinger Bands hugging the Bollinger Bands on the upside, and then you start to move away. You start to move below that moving average, which is the 20-day moving average, which is around which the Bollinger Bands are calculated, and that would suggest that you're probably now likely to come back towards the lower Bollinger Band. So the expectations seem to have changed in this long euro bull run from the middle of April, and I'll talk you through that in a bit anyway. But that's on the Bollinger Bands. Now, parabolic SARs, this is interesting as well. This is the parabolic SARs which are the blue dots on this chart. Parabolic SARs on sterling. This is a 10-minute chart of sterling. Now, when markets are trending strongly, parabolic SARs work excellently, and they basically flank your trade, your strong run higher. And look at this. Look at what your parabolic SARs. If you'd used them this morning on your strong run higher on sterling, you would have been able to run this trade all the way up, and then when your parabolic SARs start to get tripped, which is at this stage here, you then start to think about closing out your position. So effectively, it is like a trailing stop loss. And since then, your parabolic SARs have turned over, and the market's become a bit more range bound, but you would have been out of that position. It may well continue to go higher. I actually think the cable ultimately will be going a little bit higher, but in the near term, the near term outlook has gone neutral. So you use the parabolic SARs to trip your stops, and you think, okay, well maybe I should now think about locking in that profit. That's had a good strong run higher. I use the parabolic SARs as that profit trigger indicator. And that's it. Right, that is the theoretical aspect of my webinar. So I'm going to now look at live market information. So I'm going to start off with the euro. Let me just look. I don't know whether I've got some questions. I have got a few. Oh, crikey, sorry. What about a winning trade? But just a few pips. We wait for a considerable time. We're all still positive, but a few pips. Do we close the position or keep waiting? Okay, let me just think about that. We are just okay. Yeah, as I said earlier, I mean, just basically, if you're, as I said, just look at the different market conditions. If market conditions have changed, and you're sitting in a profit, you then think about taking your profit out, perhaps taking your position and closing it. Or if you're still positive, then why not run the position? If you're sitting in just a few pips of profit, probably there's no real need to. I mean, depends on how big your stop loss is really. But if you're sitting in a few pips of profit, then you probably haven't sort of got enough upside yet to sort of justify moving the stop loss. However, if you're sitting in net profit and then you start to see that profit falling away, moving into a loss, maybe the market conditions have changed, maybe the outlook or the expectations have changed. So maybe start to think about using that change of expectations to manage your position and maybe close the trade. Okay, Osman, when we hear do not let a winner become a loser, what does that actually mean? I'm a short-term trader. Does that mean I can close it even? Well, I mean, I would say, I mean, for that, obviously you're a short-term trader, so it depends on exactly how many pips you've got as your profit or your stop loss in place. I mean, you've got 2 pips of profit before you start to retrace. I mean, that's not. I mean, from my perspective, I'm looking to trade sort of intraday towards maybe over a day, maybe 2 days basis. So a couple of pips worth of profit is not a big profit for what I'm looking to do. But if you're a very short-term trader, maybe you're looking to sort of lock in 2, 3, 4, 5 pips worth of profit, and then it obviously all depends on your trade size. But if you see that sort of only a slight move into profit before you begin to retrace, then perhaps that retracement is due to a change of expectations. I think that is obviously something you need to bear in mind. If you're only 2 pips up before the market turns around, it's probably not necessarily the best time to trade, perhaps. So you need to think about all these things as well. But yeah, just be careful. It all does depend on your trading time horizon as well, from what I've been talking about. So I mean, obviously I've been using sort of examples of 50 pips stop losses and 100 pips of profit target. You'd be looking out for, I mean, that's on my horizon. That would be from sort of doing intradays towards maybe 1 to 2 day trades. I mean, if you're trading in sort of on a if you're a day trader, you're in and out very quickly, then that's an entirely different way, and you need to sort of manage your positions accordingly. Right, okay, on to the euro. I think the outlook for the euro has changed in the past 2 days. What we saw yesterday was a close below the key reaction low at 11:30, and I think that now changes the medium-term outlook, which had been positive, to a more very at the very best a neutral outlook. The thing I would point towards would be the momentum indicators. You've got the RSI, which is already broken below the 11:30 low, and also the low that we saw at 1065. 1065 is now a massive support on the euro, by the way. And so the RSI is already sort of fallen to a 3-week low. The MACD lines have crossed over bearishly. That is a sell signal. The stochastics have also given a sell signal, falling sharply. I would say that the daily chart would suggest that the euro is now under pressure, and I think that rallies are being seen as a chance to sell. Now, this is the hourly chart, the chart that I look at as well as the daily chart. Look at this massive support that you've got in at 1065 across May and late April and early May. 1065. Massive support. Yes, you slightly dipped into sort of 1061 on my chart. I mean, different charting or different charting packages have different levels, but 1061 was my low. But you wouldn't say that support has been broken yet. What I would say is look at these hourly moving averages, hourly momentum indicators. The MACD lines have been very negative and have just unwound to neutral. The RSI had been very negative and basically fallen over around the 60 point. So these are all sort of classic unwinding technical signals, I would say. You've got a big overhead resistance coming in at 12 big figure, which has been a bit of a pivot level over the last few weeks. You could even extend that almost to that level as well there. So you've got consistently 12 big figure sort of comes in as a basis of support and resistance over the last few weeks. And again, I think today we're going to see, I think 112 big figure act as that ceiling now. And I would say that this is an unwinding rally that I think is going to subsequently fall over and retest that 1065 level, because I think that the bulls have lost what's even the word? The bulls have lost control of this move higher. The sequence of higher lows has now been broken, and I think it's now turned around. I would say this is now at best a range play, or even a corrective move down back lower again. Okay, sterling. I'm actually quite positive on sterling still. I know that the dollar has sort of turned around a lot of trades, but look at this uptrend on sterling back from that April low, hit bang on and used 3 days in a row actually as the basis of support, as it was back in the early May time actually. And you've seen a strong move higher. Yes, the strong move higher has come on the back of retail sales out of the UK today. However, you've seen all these technical indicators still positive on that euro trade or euro chart I showed you earlier. The reaction low, so the RSI is at a 3-week low. The RSI has not done that on cable. The MACD lines have come together and it look like, I mean, I suppose they could still cross over bearishly. However, it looks like they could well kiss as well and turn higher. The stochastics also still above that early May low. So all these momentum indicators are still in positive configuration. Also, you've got this sort of 21-day moving average, which I see as a bit of a sort of a decent gauge. If I sort of zoom out here, it's been fairly reasonable over the last few months, this green moving average, as your basis of sort of support and resistance. And it's now supportive, and that comes in at 54.20 at the moment. Here we go. Just as another one, this massive old resistance at 55.50 was the breakout level. And you sort of, I would say you've just unwound back towards that. Yes, it's sort of gone a little bit below that. I would also argue that the 55 figure level is also a big support. And we didn't see a close below that, actually. What we did see is a slight dip, but then subsequently traded around that level. So 55 big figure is a big support. And 55.50 now also as you go through. So I think this run higher today, I think it's consolidating. I showed you on that on the parabolic SARS that sort of just consolidating really. That's the move we've had today, and I think it's just a consolidation now. But I think that ultimately dips will be bought into on cable, because I think all these markets basically are now in range play. I think we're now out of a strong dollar trend, and I don't see necessarily any strong bull trends developing. I think this trend that we do have on cable is a good trend at the moment. I'd be following it higher. However, I don't necessarily think it's going to go too far before you're going to start to see a bit of resistance coming in again. But I think at the moment you're going to have to. I think you should still run with this trade higher. Japanese yen. Now this is your classic range trade at the moment. Let's just do the hourly as well. This is your classic range trade. It's months now, 6 months it's basically gone sideways, done nothing. Let's just zoom in and just see that it's interesting actually, because we've had 3 strong bull candles in a row now. 4 positive candles, but 3 strong bull candles. And I would say that this move that we've had today is just an unwinding move, really. That breakout at 120.85, that old breakout there from the April high. What's today's low? 120.82. So within sort of 2-3 pips of that breakout. Very interesting. Also, this is last few days. We've just unwound back to this uptrend as well. Strong moving averages. Momentum indicators still positive. MACD lines have just unwound back to that neutral point. I would say that I said this morning in my daily video that I thought. I said today that I thought that you'd get a buy signal in between sort of 2050, which was an old breakout, and that 2085 level. Seems to be maybe you've got that at the top, but I would still see that just a slight consolidation. But I think perhaps you're going to come back towards. Oh, it's frozen. Okay, where are you? Right, there you go. I think you might. The chances are, I think you're going to start testing these sort of range highs again. Because you look at the momentum indicators, the RSI is now above 60. MACD lines are starting to pick up. Stochastics are strong as well. So I think across the board, you're still getting some you're now getting some positive signals. I think corrections on this yen are a chance to buy. Just a quick comment. Sorry, jobless claims haven't been shown on cable yet. Jobless claims came in, was it 274? Against 271 expected, so there's a slight upward move on the last week. But to be honest, I think it was fairly neutral in terms of jobless claims and the impact that they had on the dollar. I think the dollar was more sort of moving around on the existing home sales that had a sharp decline today. Right, Aussie. Interesting, Aussie. Again, sort of dipping back in. I mean, you sort of, again, once more, you're in a range trade, aren't you, on the Aussie? Last 3 or 4 months, trade just moving sideways and not really going anywhere on this. So if you just zoom out, so you've broken that big downtrend and you're now moving sideways on the Aussie. And you can sort of start to think about range playing this Aussie. Momentum indicators suggest a range play. Slight turning over of the MACD lines. And also, stochastics gave a bearish divergence there, so that sort of triggered this sell-off, I think. But I would still I'd still be using. Let me just change this on the hourly. Yeah, you're still in this corrective phase. You've still got this big downtrend on the Aussie in the last few days. But you're back into a lot of these sort of breakout levels now. 784 is an old pivot level. Old historic pivot level. So crikey, you can go a long way further. Look at that. Look at that level at 78.40. So that is your initial level now that you need to be looking back at. You could well see that you'll come back towards that sort of level and start to find support again. There's a minor level back at 78 figure as well, so sort of 40 pips worth of support coming back in. Ultimately, you're only sort of 80 pips away from that now, but you're still in this downtrend on the hourly chart. So you'd still say that the corrective play is still in place. Sticking in the crosshair there, and you're still seeing the RSI falling over around the mid 50s. If you start to see the RSI pushing out to sort of a 5-day high, then you might start to see this downtrend being broken and a continuation of that range. But for the moment, we are still sort of slightly Aussie negative on this trade. Kiwi. Got a similar sort of downtrend there, haven't we? On the hourly. Let me just do the daily. A little bit more sort of negative within that range, sort of back towards the bottom of this range, but still a range nonetheless. Again, if I zoom out here, you've sort of broken this downtrend and you've basically been going sideways now. You're in this range. You're sort of coming back towards the lows of the range, and it may well be that we start to form a bit of support. I don't necessarily think that the dollar bull run is going to continue, so subsequently I don't necessarily think that the Kiwi is going to break lower. So at the moment we're in this downtrend phase. All the moving averages on the hourly chart are still negative, and I think that it's very interesting that we're sort of still seeing the MACD lines negative, and the RSI, as I said earlier on the Aussie, the RSI is still negative configuration as well. So until you start seeing that positive above 60 on the hourly RSI, I think you're going to still see this running lower and putting downside pressure on. Right, I've been told I've got 5 minutes left, so let's just quickly look at gold. Another range play, another range play. Everything is ranging at the moment. So the last few weeks on gold have been, let me just sort of zoom out quickly here. We've got these sort of descending-ish trend lines here sort of trend channel, I suppose. But within that, I think you are basically just trending sideways. Last few weeks or a couple of months even, you've had this move back towards the sort of 1178 low. You had a slight poke below, but never got a close below. And you've had a slight poke above, never really got a close above 1224. Yeah, I mean, I suppose 1225 was a breakout, but you never got any real conviction on the indicators, and it was always a little bit of concern of mine that that was happening. And subsequently, we've seen this sharp bear candle, and again, sort of a spinning top candle yesterday is a bit of a neutral candle, and today again we've seen a negative one coming through. Now I would say you're coming back towards what I see as sort of a pivot level, arguably around the sort of 1200 area. I haven't got it drawn in here, have I? Okay, let's stick that there or there. So 1200 I see as a bit of a pivot level near term. And I think you're coming back towards that. I mean, 1200 is actually basically bang in the middle of this range anyway. So I think that's where we're coming back to. Momentum indicators are very sort of corrective near term. MACD lines have rolled over again, so I think that puts pressure on it to the downside. You might see a move even back towards the 1190 area. But at the moment, certainly the bears or the corrective forces on this chart are in play, and we've sort of broken down again today. Had this sort of consolidation over the last couple of days, but it seems to be that sort of pressurizing back towards the downside again. So you'd be using sort of near-term rallies in gold as a chance to sell. One more. Let's do the DAX. DAX is, interestingly enough, a very good negative correlation with the euro. Interestingly enough, I say. You've had a bit of a choppy. I think what we've seen, it did build this top pattern, which actually gave us a downside target 10850. It's now seen that turn around, so that would suggest that maybe a bear market target. A bull market correction target has not been hit, so that would suggest you're still in a fairly positive mindset on this chart. However, I think it's more of a range play, really, and you've got a lot of resistance overhead. You've got that big, around 1200, you've got the big Fibonacci projection level of 161.8, which has been a very consistent sort of trading area across the last few months, couple of months, and also these big rally highs from April. So around the 12,000 area, it's big resistance. But on the flip side of that, you have also broken back above some key resistance levels, which is that's the old neckline at 11,620, and you've broken above these key rally highs. So you're sort of in a near-term, more positive frame of mind. I think perhaps you may well see now a move back towards 1,200. Again, if you're positive on DAX, you're negative on the euro, and I am negative on the euro. So it's sort of two parts of the same trade, really. I think the DAX has improved significantly in the last few days, and it certainly looks like it's holding on to this upside move. So your initial support around that 11,700 area, and I think that I'm more positive on the DAX than I have been for a while now. So very interesting move on the DAX there. Have I got time for any more? Any more? Let's do one anyway. All right, let's do FTSE. No. Let's do oil. Sorry. Let's do oil. Oil is very wow. It's just taken off in the last couple of hours, actually, and that is annoying in a big regard because I started to think that this was a big top pattern that was breaking down, and it's just not stopped since then. It's just bounced and not stopped. I've got this level of resistance in here, and that is comes in at 688, I think. Yeah, 6088, and we're actually just slightly pushed through that. So look at this reaction on the hourly RSI. So there was clearly no real desire to sell off oil, and I think that this is again part of this whole sort of sideways ranging phase that the markets are in, and I see that oil is obviously playing a part in that. You had this bull base pattern above 54.24. That actually gives us a 65 figure target on oil. But this near-term sort of corrective pattern that on a move below 58.30 sort of completed the downside target, completed a downside move, but the outlook still remains pretty mixed, it would appear, because the reaction to that sort of breakdown has been very positive, actually, and sort of turned that completely on its head. Now, you'd say that if you sort of find a resistance again under 61.85, then you would say that you're in sort of neutral near-term chart. However, breaking above that 60, that reaction high, that lower reaction high at 61.85, I'd say that turns you more bullish again. And this is turning into a pretty strong candle day. And certainly the bulls are on the run at the moment, back higher. And if it continues up towards, as I said, that 61.85 level, then I think you are going to be sort of looking more positively again, back towards 65, or at least that 62.60 area, which was that reaction high in early May. Yeah, lots of so basically this again is another one of these really choppy charts that we've got going on here at the moment. No real sort of trend developing. You get a lot of false signals, and that is indicative of a ranging market that you're getting at the moment. So just be careful on that. Right. I wish you good luck. My final slide, there you go, is to do with Hantech markets. Now, Hantech, this is our website. If you go to www.hantechfx.com, and you've got my research site as well. If you go /market-research, you've got all the recent recent reports I've written. I do daily market videos on euro, sterling, yen, and also gold. And I'll do a weekly strategy video as well. And I'll morning reports and daily reports as well. So lots going on the website. So you can go there. And my Twitter handle is, oh no, where's that gone? It's HantechRich. Anyway, HantechRich is my Twitter handle. So I will happily engage with you if you choose to engage with me. Anyway, thank you very much for listening today, and I wish you good luck in your trading. And I will just show you my disclaimer once more, just in case you missed it the first time. It's good fun, that, isn't it? Anyway, I wish you good luck, and I will speak to you again next time. Thank you very much for listening.